If you're an ICT trader, you probably don't have a problem finding PD arrays. You have a problem deciding which one actually deserves your attention. A fair value gap, an order block, breaker, an inversion fair value gap, a rejection block can all look like valid entries on the same chart. But before the move happens, how do you objectively know which one will hold? That's the problem I needed to solve. PD arrays can show us where price may react, but location alone cannot prove that delivery has changed. I didn't need another box, I needed confirmation, and that became the foundation for my CSD framework. In this video, I'll show you how my CSDs bridge the gap between potential location and objective confirmation, how my Type 1 and Type 2 CSDs fit into one repeatable model, and why the best CSD is the one that agrees with the environment, directional bias, location, and drawn liquidity. In this video, I'll show you how my CSDs bridge the gap between potential location and objective confirmation. My Type 1 and Type 2 CSDs will be the intro to your objective protocol to determine CSDs. By the end of the video, you'll stop asking which PD array will hold, and you'll start asking the more important question. Has price actually confirmed a change in state of delivery? Opposed to has price printed another fair value gap, bro? So I hope you enjoy this lecture. Fair value gaps, order blocks, breakers, which one actually matters? These concepts can be extremely useful, but they can also create a major problem. When several valid-looking PD arrays appear on the same chart, how do you objectively decide which one deserves your risk? This video is not meant to discredit ICT or suggest that PD arrays have no value. PD arrays can give us important information about where price may react. The problem begins when we expect location alone to confirm that price is ready to reverse. A PD array can identify a potential area of interest, but it cannot prove that delivery has actually changed. That is where changing the state of delivery becomes important. In this video, I'll show you how CSD can help bridge the gap between finding a possible location and receiving objective confirmation. This is where your introduction to Type 1 and Type 2 CSDs and the objective framework that you may have been missing from your execution, right? The 2022 model works, the silver bullet model works, all of those models can work, but you need an objective approach to how you enter these trades. So let's begin with the problem most traders eventually experience. You open the chart and identify a fair value gap. Underneath that, you find an order block. Then you notice a breaker. Then you have your inversion fair value gap. Then you have buy side and sell side liquidity. You have your new week opening gaps, OTE, etc. Sequential SMT here, regular SMT here, time cycles here and there. This and that, this and that. Every one of these areas can appear technically valid, right? Especially in hindsight. Trust me, I've been there myself. I traded ICT for years. But now you have too many choices, right? Should you insert at the fair value gap? Should you wait for the breaker? Should you wait for the order block? Should you even trust the specific breaker, right? Is it because you see this swing high here, it takes liquidity, takes a swing low, so now you have a break in the structure, it comes back to the breaker and inside of inversion fair value gap with sequential SMT, so that is why it helped, right? That's why this one worked, that's why this one worked. The chart may contain several valid locations, but does that mean every location deserves a trade? This is where execution can quietly turn into guesswork. Traders often look at the results afterward and say, I should have used this PD array instead, right? But before the move even happens, we need a repeatable decision model, not hindsight. The solution begins by changing the question. The old question is, which PD array will hold? Right? The new question, or the better question, I should say, is has delivery actually changed? That shift is extremely important. Instead of demanding that location predict the move, we have to allow price to provide that evidence that the move may have already begun, right? That evidence is what I classify through my CSDs, right? Through my change in the state of deliveries. That is what CSD stands for. If you are new to ICT concepts or Goldbach or whatever it may be, or maybe you're even new to trading, this is what a CSD stands for. Change in the state of delivery. This can also be break of structure, market structure shift, just regular reversal, V-shaped recovery, whatever you want to call it. That is basically all the same thing. So PD rates can still matter, but it is no longer responsible for confirming the trade by itself. It gives us a location, point of interest or where to pay attention to, but the CSD is what has to give you the confirmation. This is the distinction I want you to remember throughout the video. A PD array answers where might price react, right? That is just a point of interest by itself, right? It is just a potential area. That is where price may react. But a CSD is delivery confirmation, right? The way that I framed my CSDs, it gives me a delivery confirmation. I actually have an objective way to determine a reversal that I can repeat over and over and over and over again. So I stopped needing to predict a reversal, right? I stopped needing to have to use things like bookmap and trying to use 3-point stop losses and trying to catch a very, very tip, a very specific move. And I just waited for the confirmations instead. Those are two completely different jobs here, right? One is a point of interest. The other one is telling you that it's time to enter a trade. One is telling you where to pay attention. The other one is telling you when to execute, right? Those are two different things. If price reaches a fair value gap, an order block, or another important level, that just tells us we have entered a potential reaction area, right? That just tells you to start paying attention. It doesn't automatically mean buyers or sellers have taken control. Price can touch a valid PD array, react temporarily, and then continue directly through it. That does not mean that IPTA is ready to reverse just because we have reached this fair value gap on a 4-hour time frame, for example, right? The algorithm is not reacting specifically only from that fair value gap. Now, that does not necessarily mean that the concept is useless. It means that the location never received the necessary confirmation on its own. This small change made my decision making much more objective. Within my framework, I classify delivery changes into 4 primary CSDs: type 1, 2, 3, and type 4 CSDs, right? These are my 4 CSDs that I created. These are not 4 random entry patterns. It isn't an order block, a liquidity sweep with a breaker and a fair value gap, right? Those are just pattern trading. I'm sorry to say this, I'm sorry to break your heart, but if your entry model is liquidity sweep, down close candle followed by fair value gap and entry at the fair value gap, you're no different than a head and shoulders trader. I'm sorry to tell you this. I love ICT and everything that he's done for us. I love ICT and everything that he's done for us, but that is not objective. That may be repeatable, but then you can find that on 5-second chart, 15-second chart, 30-second chart, 1-minute chart, 3-minute chart, so on and so forth, right? Without any actual framework. The purpose is not to add even more entry models to your chart. The purpose is to create a repeatable way of determining whether delivery has objectively changed, right? So in this lesson, we're going to primarily focus on type 1 and type 2 because those are my 2 strongest CSDs and my 2 favorite CSDs. As we continue through this intro to my model series, I'll be going ahead and showing you live examples on the chart and show you how to apply this. You can go ahead and back test it and then forward test it in the actual charts. Here's what changed my own analysis. Before using CSD as confirmation, my charts contained multiple PD arrays and too many possible decisions for me to make on my own. Every new box created a new potential opportunity, a new entry. The analysis may have looked detailed, but the execution was still discretionary because I had no objective method for choosing between those locations. After introducing structured Goldbach levels, like you see here, these are the Goldbach levels, and my CZ confirmations, the charts became much easier to interpret. I could identify the important location first, and then wait for the price to confirm whether that location was producing a meaningful change in the state of delivery or not. This does not guarantee that every trade will win. No confirmation model can eliminate losses. What it does reduce is unnecessary discretion. The process becomes cleaner because I no longer need to enter simply because price touch an order block box or a fair value gap. Which one of these will hold is very subjective when coming to a chart like this, right? We have too many choices. Here we have our range high, like I said, here, highs form here, lows form here. We have our low, we have our high, and then we have our ranges in between. And the red zone is our rebalance area, which basically means our equilibrium where price tends to consolidate, right? Lows form here, highs form here, price chops around in the middle. I already know what to look for with rules. There is another important point that I want to make clear. CZs do not operate alone. Finding a CZ does not automatically create a valid trade. My full decision begins with my environment. Then, after my environment is clear, I move on to my directional bias, then my point of interest, which is my location, then I do my CZ confirmations, then finally that's when I execute. So that is the complete sequence. Environment, directional bias, location, CZ confirmation, and then the draw on liquidity followed by your execution. CZ confirms the idea, but the surrounding context qualifies it. This is where many traders can accidentally recreate the same problem. If we begin trading every CZ that appears, CZ simply becomes another pattern that we chase around the chart. And then like I said, we become no better than pattern traders, right? Yes, this is the schematic for a type 1 CSD, but every time you CSD, does that mean that you should automatically take it? No. All that is doing is giving you a directional bias for this specific dealing range. Yes, I do care about the CSD, but I want the environment to make sense. I want the directional bias to agree with me. I want the location to be favorable. I want the discounts or premiums to be on my side. I'm not simply entering just based off the CSD on its own. So please do not take this video out of context and try to take every single type 1 or type 2 CSD that you see. Okay? That is why we have this specific slide here. So here we have the time frames and the assigned dealing range to each time frame. So the same time frame use a different power of 3 range on NQ and ES, meaning that on NASDAQ, these are the time frames that we're paying attention to, and these are the time frames that we're paying attention to on ES. Notice how they're the same 4 time frames, but we have different dealing ranges on the right side, okay? The left side of this are the time frames that we're using. Yes, I know these time frames are unconventional, but on TradingView you can make custom intervals. What you have to do is click on your time frame, add a custom interval, and you have to add these specific time frames to your TradingView chart. After you do that, for the NASDAQ, for the 9-day, we're going to be paying attention to the 6561 power of 3 range. For those of you who are new to ICT and power of 3 dealing ranges, don't worry about it. I will explain these in the chart. But essentially, these are ranges that consist of power of 3 increments, meaning that from range low to range high, there is 6,561 points. Same thing here. From range low to range high, there's 2,187 points. So on and so forth. 729 and 243. Now go ahead and screenshot this, write this down. And one thing to make very, very clear, these time frames are constant. They never change, meaning these are the only 4 time frames that you need and will ever need to determine directional bias. All right, so here we are on the daily time frame for the E-mini NASDAQ continuous contract. And I'm using the continuous contract so I could go back in time just to show you guys a very cool example and how you could use the type 1 and type 2 CSD logic to confirm the low of 2025. So now here we are on the daily time frame, right? This is the opening of 2025 in this specific area. Notice how we can go sideways for a bit, and then we have this huge sell-off. How could we determine that this was the low of 2025 without taking a swing high, right? Without creating the essential ICT market structure shift pattern where we take a swing high with a fair value gap. So even before this happens, or we take any of this high here, how could we have known that the reversal was in and that the potential swing low of the year was also in? Now, another question I want you to ask yourself is, how do we know which one of these lows is the actual draw on liquidity? Here we end up even taking this low here on the daily time frame. And if we go back far enough, we take this low here as well. So now, where is your premium and discount? Are we anchoring to this low here to go here? And is this the pullback, right? At first, are you thinking this low? Are you thinking this low? Are you thinking this low? Or are you thinking this low, right? Or, like I said, was it all the way down here? And is this the OTE that it reached? Or was it all the way down here, right? And is that the optimal trade entry? Oh, look at that. OTE aligns. When you match it to that swing high and to that swing low, boom, there you go. That's the reason it happened. But can you tell me that you can do this continuously and not just do it in hindsight? Can you predict this? Can you tell me that this is where the highs should form? Or is this where the low should form? Is this where a low should form? Right? These lows are kind of similar. These lows are kind of similar. These lows here are also kind of similar. Does that mean that this is where lows should form? Is it here? Is it here? So that's what I disliked personally about the subjectivity of ICT concepts. Yes, I do believe that the markets are rigged and controlled by algorithms, meaning that the algorithm should follow mathematical principles. And ICT is always talking about the numbers powers of three, right? Most people think power of three is accumulation, manipulation, and distribution. But have you ever thought about the literal powers of three? And that is where Goldbach comes into play, right? We create objective dealing ranges that start on power of three ranges from 0 to 3, 9, 27, 81, 243, 729, 2187, 6561, etc. So now if you remember the time frames from the slide previously, I'm going to go ahead and put that specific time frame on this time frame, and you're going to see how the highs form at specific range highs and lows, and how we rebalance inside of rebalance zones. All right, so now we have what Hopiplaka has created as the Goldbach trifecta levels, right? All credits to Hopiplaka for creating this trading method and for figuring out what ICT was really trying to tell us the entire time. So here we have green equals range highs and lows, and red equals equilibrium, meaning 50% or consequent encouragement for us ICT traders. Now these are the green zones here, here, and here. And then we have red zones in the middle of each green zone. And this is the middle of the following green zone, as we can see here. Now I want you to notice how highs are forming around the green zone, lows and market maker buy models are starting in green zones here, highs here, lows here, again, market maker model starting from the green, and here starting from the green and ending in a green again as well here. Okay? These are not random. These are what you may have heard of called bank levels or institutional levels. These are the actual levels that they are referring to. So now each one of these levels has a specific percentage assigned to it. Okay? At the bottom, when we're trading inside of this range, for example, from here to here, once we're in this specific candle here, we are trading from this green zone to this green zone. So that tells us an objective way to identify premium and discount. This red zone is our equilibrium, and the line in the center is our 50%. So above the red zone is our premium, and below the red zone is our discount. Now I'm going to go ahead and add the percentages to the right of this. Okay, so here we have the percentages of each level, right? The bottom is labeled as 2187 and 2187 at the range high as well, okay? So currently this says 2187 high because we're trading in between these two green zones. Notice that. So this says 2187L, which means low, 2187 high, and it has a plus 19,683 because that's the next highest power of three range that this specific level here also aligns to. So when multiple power of three ranges align, the indicator will show that, right? But not, let's not make that too complicated. And let's focus on primarily the green and red zones, okay? Here we have the 50. So that literally means, that means from this 50% all the way to here is our premium. And from the 50 below down to the 0 is our discount. So here in the bottom, from 50 to 0, this is our 0%, 3%, 7, 11, 17, so on and so forth. Right? Over here we have 53, 59, 65, 71%, so on and so forth. So now we have an objective way to determine premium and discount. You're not guessing premium or discount anymore. Now you know when something is expensive and you know when something is cheap. You now have an objective way to determine each and every single trading range. And for those of you who are new to ICT as well and may just come from regular support and resistance backgrounds, view this as support and resistance. These are the true support and resistance. And I've always said before that I believe what ICT was trying to teach us was a rule-based way to determine support and resistance. And that's what fair value gaps do. That's what rejection blocks do and order blocks do. Those are ways to determine support and resistance. right? The only problem with that is that we can find so many order blocks and fair value gaps. Whereas this, because it's based on the power of three mathematical principles, it is always constant. So now how do we use these levels, right? Let's keep it basic. When we're trading inside of these two zones, every time we reject the specific area, you want to be looking for sells. And down here, you want to be looking for potential longs to form. Okay. Now that does not mean the moment that it touches this area, you're automatically going to enter. Okay. There are multiple things that I pay attention to when I'm looking for an entry. But when I'm determining directional bias, I have a clear cut way of doing so. All right, so here we have the schematics for a type 1 and type 2 CSD. So for the rules of type 1 and type 2 CSD are very straightforward and simple. And now I'm going to show them to you. All right, so here we have the rules for type 1 and type 2 CSDs. So type 1 is when we touch either 0% for a buy or 100% for a sell, and then closes above the 11% for a buy or closes below 89% for a sell version of a type 1 CSD. Here, the schematic shows it clearly. We come down to 0% of the range, right? This is the range low. Here we have the 0%. We touch the 0%. The candle then closes above the 11, which is noted here. And once that confirmation is in, so touch the 0, close the 11%. After that, our type 1 CSD is in, and you expect this entire green zone here to hold. And what you want to do is attack an opposing premium, right? ICT always says we go from discount to premium, from premium to discount. This is what he was referring to. This is our type 1 CSD. So once that confirmation is in, then we know that we can enter with our stop loss below the green zone to attack at least the 50%. Same thing goes for a sell model of the type 1 CSD. We reached the 100% this time, not the 0, but the 100. Close below the 11. After that, we expect this entire range high to hold for us to attack 50% of the range. Okay? And this is exactly what those two would look like, right? So this is what you would be looking for, y'all. And it always offers at least 2R from the range lows to range highs. Okay? So that's the visual representation of a type 1 and type 2 CSD. So now let's move on to the type 2 CSD. The type 2 is when we fail to reach the 0% here, right? We don't quite reach the full 0, but we do reach the 11%. We can also touch the 7 or the 3. It does not change anything. As long as we touch the 11 with a wick or a body, that is valid. After that, we need to close above the 35%. Once we close above the 35%, we have confirmation of a type 2 CSD, and the same rules apply. You enter expecting the range low to hold to target a premium, okay? And notice how I'm not saying target a swing high, target a fair value gap, target an order block, because those necessarily do not matter. All we're doing is moving from discount to premium and from premium to discount over and over and over and over again. Now, for the sell example, we reach the 89%, close below the 65, return to it to then again seek discounts, right? Notice, very clear cut. One reaches the 100 and the 0, while the other one does not, right? The more favorable one is obviously going to be the type 0 because it's going to offer the best risk to reward, whereas the type 2 offers slightly less risk to reward, but it still has the same objective principles that we have in the type 1 CSD. So now you're not basing your liquidity sweeps or anything of that nature based on how you feel or how it looks on the 1 minute chart or the 3 minute chart or the 15-second chart for that matter. Now you have clear cut rules to define your CSDs. And you have a clear-cut way to determine premium and discount just by using the Goldbach levels themselves. Now, I know what you're thinking. What happens if we close above or below a range, right? Let's say we do here. We create our type 1 CSD, and then we start to continue higher and higher and higher. And then after reaching the range high, consolidate a bit, and then end up closing above it, right? How do we treat that, right? What happens when we have this? Well, if you remember, when we reach the 100 or the 0 and close above the 11, that is a type 1 CSD. And that's what happens here. That is how I also frame continuation trades. So my continuation trades are also objective as well. Same things apply. Once you close above this area, I want to see this area hold. I do not want to see it come any lower than this. And I want to be taking some sort of premium. And that's how I would treat continuation trades. So now let's go into the charts and see this even is applicable to the charts in real time, right? So here we are back on the charts. And what do we have here? We come to this area, consolidate for a bit. These candles open below, but only this one closes below it. So once we close below it, we're now dealing inside of this range. And then the very next candle here has a huge body closure above the green. That is way more than a type 1 and type 2 CSD. Okay? So now all you would have to do after this is enter somewhere underneath the 50%, right? So let's say you entered somewhere here and you had your stop below the green and you were just targeting premium for the rest of the year. Okay, now let's say maybe you don't like that. Maybe you don't like how big this is. Okay, because this is a 2187 daily range, so it's a pretty big time frame, right? Let's say you're a swing trader and you're trading this. All right, no problem. All you have to do is wait for the next continuation. And there you have it. Price comes back down into a discount. Where to specifically? A range low. That's exactly where low should form. And what do we have there, ladies and gentlemen? What do we have? We have our type 2 CSD. If you remember, we touch the 11 and close above the 35, and then after that, we expect the green zone to hold to then continue higher. All right, so then let's go ahead and let's execute on that idea. So now let's go ahead and say we entered 2 minis on this hypothetical. We have to have our stop loss below the 0%, and we have to be targeting at least a 2R, right? So we're risking about 42 on that. We want to hit at least 80. And what do we have here? We have highs inside of a red zone, and this is a premium here. This is a premium here. Okay, and this is the low of, like I said, April. If you also combine ICT seasonality to this, we know that that's where the low of the year usually forms. So now again, as long as we don't trade underneath this, we can continue to trade higher and higher. And look at what we have here. Notice how once that confirmation is in again for a second time, we immediately start to trade into the next green zone. Boom, right? There we go. Let's say you take one partial inside of there, right? Because you should be taking partials at a premium when entering from a discount. That's just basic ICT concepts, right? So now how do we know we're going to reach the next one? What did we go through before? We have to wait for it to close above. There you have it. There goes another CSD. So now all we want to do is make sure that it doesn't trade below this green zone to target the next green zone. And if we play this forward, well, we can see that that's exactly what happened. And when we go ahead and play this forward, the same thing continues to happen over and over and over and over again. Here it happens again. Trades above, never closes below, continues to trade higher over and over and over and over and over and over again. Here it comes back into a discount after reaching the range high to then continue trading higher over and over and over again. So the main takeaway is simple. I stopped asking which PD array would hold and I started asking where the price had confirmed my CSD. Yeah, your PD arrays can still matter for points of interest, your fair value gaps, your order blocks, and breakers. You can still pay attention to them. But I just showed you how to objectively determine premium and discount. And would you not lie to yourself for a second and tell yourself that that's exactly what you were doing with fair value gaps? That's what you were doing with BISIs. That's what you were doing with SIBIs. You're looking for an area of interest. You're looking for somewhere to enter. You're looking for the draw on liquidity, right? You're looking for the inefficiency in price. Where is the inefficiency going to form? At a discount, right? Where are the premiums going to form? At a premium in the range highs. Location tells us where the idea may develop, but the confirmations give you the actual trade idea. That's what tells you what you can enter based off. And when we combine these two things, we have a beautiful Goldbach trifecta. If this helped you look at PD arrays completely different, if this blowed your mind, if you're backtest this over and over and over again, comments on the YouTube video below, tag me on X, show me your trades, and as always, good luck and good trading.